Today, we are going to talk about bond investments. I recall a part of my financial career, I had the privilege to serve as the head of portfolio management for a leading insurance group in Hong Kong, and where I was responsible for managing general investment accounts for the company. During those times, we make direct investments in China's bond markets for portfolio diversification and also for managing relative value trades. I hope through this video, we can provide you with practical insights on how foreign investors can access China's bond markets and the essential need-to-knows. As we can recall, China's bond market has faced significant turbulences over the years, which was driven by a mix of domestic and global challenges. As we all know, the real estate crisis, which had triggered fears of contagion to local governments and also corporate bond markets. In the meantime, economic slowdown and stricter debt controls have tightened credit, especially when China prioritized deleveraging to curb financial risk. The borrowing cost rise, squeezing liquidity in the market, and of course, pressed down bond prices. Externally, during US rate hikes, capital was lured out of China, while geopolitical tensions and recession fears compound volatility. But why do we bother to discuss this topic now? Part of the reason is that the bond landscape has been changing and the momentum is coming back. In the interbank bond market, over 60% of trading is controlled by commercial banks, such as ICBC or CCB. But these Chinese banks are not alone. Insurance companies, fund managers, and even foreign central banks like the Bank of Japan, BOJ holds around 150 billion USD in Chinese bonds. Here is the ticker. This market moves at extremely high speed. Trades happened instantly on the electronic platform or through private deals. Nearly all settlements are cleared within a day. And worth noting is the default rate is as low as 0.03%, which is way better than emerging markets, which is 0.15%. Now, how do you play around it? There are two doors here. The first one is CIBM Direct. Think of it as the VIP entrance. Sovereign wealth funds and global insurance companies like to use this, including my previous company. To join, you will need deep pockets. You need to have at least 500 million in assets, and you need to partner with local custodians such as ICBC or HSBC. How about the payoff? You will get access to every types of bonds, even illiquid AA rated corporate bonds, plus tools to hedge yuan volatility using currency swaps. And option 2 is Bond Connect, which is the express lane. It is simpler but limits you to investment-grade bonds only. Since it was launched in 2017, it has pulled in 1.2 trillion from global asset managers and ETFs like the iShare China Bond ETF. Let's look at the trade volumes. Northbound Bond Connect, the monthly trading volume of January 2025 was around 900 billion RMB, and the monthly average daily turnover stood at around 46 billion. Chinese government bonds and policy financial bonds were the most popular bond types, accounting for 34% and 44% of the trading volume. In terms of tenors, 7 to 10 years make up 34% of the trading volume, followed by less than 1 year tenor, which is around 31%. On the diversification metric, Chinese bonds have a slightly negative correlation with global stocks, which is around negative 0.15. Unlike US treasuries, which is about positive 0.85. Also, let's not forget that big money follows indexes. 2.5 trillion in funds tracks benchmarks with 6% allocations to China, forcing around 50 billion in passive inflows since JP Morgan added CGBs in 2020. But China bond markets isn't at all smooth sailing. Liquidity is something that investors need to watch out. AAA rated corporate bonds could be trading at 0.15 bid-ask spreads, which doubles treasuries. Junk bonds daily turnover often dips below 1 million per bond, and the yuan's 8% dipped against dollar in 2022 reminded everyone that currency risks are real. Of course, don't forget about withholding taxes. 10% on interest, unlike 0% in Singapore or Germany. But here is the bottom line. China's bond market is now the world's third to second largest bond market, with 4.3 trillion held by foreign investors, which was up from 200 billion in 2015. So missing China's bond market is like skipping the S&P 500. Are you ready to bet on the next biggest market in the world?